Meta's headcount in 2023 will be smaller than it was this year. He called it the end of an era of rapid growth. This on top of Apple reporting, and Apple got walloped in the market for the first time in forever. Apple pulled back iPhone production for the 14 after slower than anticipated demand. As I mentioned on previous episodes, they've kind of done a gentleman's layoff, similar to, I think, Meta, in that Apple said you have to be back in the office 3 days a week. A bunch of people quit. So you don't have to pay them, I guess, huge packages when they quit that way. Google CEO Sundar Pichai also called out employees in July, as you guys all read. And he wrote, there are real concerns that our productivity as a whole is not where it needs to be for the headcount we have. Google, of course, 174,000 employees. So I guess the question I have for you is, are these the last towers to fall, Chamath, in this pullback that we've seen? These are companies that don't need to do the layoffs. They have tons of cash. So they're obviously doing that to maintain earnings, one would, and to maybe send a signal to employees that they need to work harder. What's your read on this past week's shoes to drop?
Well, it definitely is the end of an era. I think it is sort of like the end of this phase of big tech where you had this, unfettered growth, where these business models were largely unassailable and they, were really just fighting to grow into their valuation and just generate more revenue to justify where they traded at. And now it's this next phase where they have to operate more like a cash cow business. And so, it's an acknowledgement that the growth is tapering. It's an acknowledgement that they're going to trade on a pretty tight band in terms of multiple, which means that they have to manage expenses much more tightly, which means that they can't have a really broad-based surface area in which to operate an experiment. You have to keep the experiments small. You have to manage your expenses. You can't have employees basically, run over the place. Management has to have a firm hand in dictating strategy and what people work on. So I think all of that signals that Jason, I don't think this is the end. I actually think it's the beginning, because these companies, Apple, Facebook, Google, maybe a little bit Microsoft, are the most sensitive to valuation because they are the most widely held, right? These are the equivalent of US Treasuries in the equity markets, the safest, most predictable safe haven in times of stress. If you want to own big, chunky cash flow generating businesses that, are relatively unassailable, you couldn't pick 4 better businesses than those. And so the fact that they see enough in the horizon to say that we need to batten down the hatches should be a warning to everybody else.
Freeberg, is it as simple as this, that they're moving from top line growth to bottom line and they're going to need to look at the expenses? What's your read on this for Silicon Valley?
Well, I just want to zoom out for a second, because I remember I started working in Silicon Valley in 2001. You guys were a little older than me, I think, but we were right at the kind of year one of the .com implosion and all the fallout that happened from all the funding that happened from 97 to 99 and 2000. And so from 01 to 03, it was super deflationary. Everyone was cutting costs and all the money that had been raised was kind of being pissed away, or companies were liquidating and, so on. And then starting in 2004, which is actually when I joined Google, but there was also this big movement starting 03, 04 of what people called Web 2. Then kind of new business models and new businesses started to emerge that seemed to have real traction and real legs. And it was a different story and a much more rational story than what you saw leading up to kind of 2000, 2001. And it was around that time when Google started offering these crazy benefits, right? It was there's a gym and free food and all these amazing workplace. And suddenly everyone had to do that to keep up, right? Facebook obviously mimicked it. All the other big companies mimicked it. And then it became mainstay. And they also raised compensation in the Valley significantly because Google had really cracked the nut on how to extract value from the internet. And it really changed everything in Silicon Valley and changed everything in tech, because suddenly every tech company, whether you were enterprise software or hardware or an internet e-commerce site, to be competitive and hire great talent, you have to have the same sort of environment. High wages, great salaries, really share the value with your employees, gyms and free food and all this sort of stuff. So it's the first time, I think, in a generation since 2003, 2004, that we're seeing things start to turn the other way, where instead of adding more benefits, making things more attractive, giving more value to employees, we're really seeing the recession hit these kind of leading indicators of how things are going to be in the valley. And as a result, I think we should expect to see a similar impact on compensation, on benefits, on value share, and on kind of proclivity to hire and opportunity to kind of jump jobs and, opportunities that we've all kind of taken for granted over the past 18 years. And this is going to be a real shock to a lot of people that work in tech and a lot of people that have gotten used to the idea that every company offers great benefits. There's always another job to jump to that'll pay you more. And that as that engine of growth that was really driven by these big companies, by Google, Facebook, Apple starts to slow, no one needs to compete with them anymore as much. And the compensation bands get tighter and the option value gets tighter and the free stuff gets tighter. So it's the end of an era. And I think it's a new world for tech and Silicon Valley.
Sex, what are your thoughts here in terms of startups in relation to big tech, maybe having these austerity measures kick in and a refocusing on profitability?
The big takeaway here is just that nobody is safe. And it's not just startups that have to, tighten their belts. It's these big companies too. And I think we're headed for a broad-based recession. That's what it seems like. You saw Druckenmiller's comments this week predicting a hard landing in 2023. No one's talking about soft landing anymore. In fact, I think we're all wondering who's flying the plane. So I think we're headed for a pretty big recession. And I just take it in a slightly different direction. I'm down here in LA. Had dinner the other night with a friend who's a showrunner in Hollywood. And so a showrunner basically is like the head writer, and they basically put together the writing team and the content for a show, and then they sell them to networks. He said that no one is buying anything anymore here. That last year there was tremendous activity, and you saw the Game of Thrones guys, D&D, they got like a $300 million deal from Netflix, and Shonda Rhimes got a $300 million deal.
They did, yeah.
Yeah, they got there were massive multi-$100 million deals being made last year. And that was just for future writing deals. Netflix wasn't even buying libraries when they did those deals.
They were locking down talent for the next decade.
Yeah, exactly. So all of that has stopped. And the reason is that Netflix's stock has been hammered, right? And not only so they not have the capital to do those kinds of crazy deals anymore, but they know that Wall Street is watching them. And so fundamentally, they're questioning whether their business model even works if they have to spend that much money on content. So then all of Netflix's competitors basically have stopped. So this whole frothy environment that you had in Hollywood last year, that's just over. The faucet's been turned off, and it's not even turned off to a trickle. It's just stopped. So you think that this massive asset bubble that we had last year was just in crypto and growth stocks. It's not. I think it actually trickled down into the real economy because Netflix was one of those growth stocks. The money then flowed into writers in Hollywood and then lots of other places. This is one small example, right? That this asset bubble wasn't purely just something that's going to be localized to crypto. It affects real people in the real economy. And we are just beginning to see the unwind of that.
Yeah, what's absolutely correct, I think, is people were more risk-taking. They had free capital. They wanted to place more bets. And sure, why wouldn't you bet on the Game of Thrones writers for the next decade? But looking at this is going to be fantastic for startups. I mean, the startups I've worked with over the last 5 years they always come to me, I got a developer, but this person's got 3 offers from, Facebook, Google. And they're like, how do I land this person? They got $300,000 a year offering $1 million in RSUs. And basically, founders had to say, no, I can't get that person. And so they had to get creative, and they would hire people, Ukraine, Uruguay, everywhere in between, to try to find developer talent, and they had to get creative. Now, all of those people are not going to have 4 job offers. They're going to have no job offers, so they may have gotten laid off. And those crazy, unrealistic out-of-school deals are going to be gone. And this means massive consolidation of talent. You look at the startups community right now, tons of companies are just going out of business. They're packing it in. Those people are going to go work at the other startups that are stronger. So whoever makes it out of this as a startup, this is how the cycle restarts, is talent then consolidates on the winners. It would be like taking the NBA and getting rid of the bottom, 10 teams and just telling the best players there, move up to the other teams, and everybody else, you're out of the league. So I think this is incredible setup for 2023 for startups to consolidate talent. So I'm actually excited to see us.
It's another data point that, again, I said it last week. I'll go out on a limb and predict my equivalent November fall predictions. Last fall, it was that the markets were going to poop the bed. My prediction now is that I think the markets are bottoming and consolidating.
Yep, 100%.
And this is the time, I think, to start nibbling and start getting ready to really rip the money in. And I think there's enough signals every day that kind of like tell me at least that on the margin, it's time, because I think the markets do a reasonably good job of digesting news and then pricing the forward reality, right? Like today's price is really everything we already know. And so the real guess is what's about to happen in the future. And from my perspective, I'm actually pretty starting to get a little constructive here. I think that when companies like Facebook really do this, and like if you think about it one way, the financial markets have always had this thing that we have called a Fed put. What does that mean? A put is essentially the right to sell something. And what market participants have always known for the last decade is that if things got very hairy, if there was uncertainty in the market, the Federal Reserve would, and they have, consistently stepped in to create a buyer of last resort. And so it always eliminated that last part of true, supply-demand balance, because they would just come and say, don't worry. In many ways in tech, what the big tech companies were that. You could never really find what the true market clearing price for an engineer was, or what the true amount of expenses you should spend on office space or, free services. Because you always had these companies, which was an escalating arms race. If one company had a massage, the next company had gyms and massage and physical therapists, and the other company would have buses to take you to the gyms and massage and therapists, and the next company would have protein shakes that were freshly made. And it just kept escalating and escalating because the costs didn't matter. And they wanted, if nothing else, to get that marginal engineer or product manager or business person to work at their company, which eliminated the risk that they would actually start something to disrupt them.
Blocker strategy is very real. You should unpack
the blocker strategies is very real. So when you take this big tech put out of the market, you will get true price discovery, and you will find out what the real price should be for this kind of an engineer, that kind of a product manager. You'll find out what are the real expenses you need to bear in order to build a real lasting business. And you'll be able to sort through all of that stuff out. So I think it's a really good moment. And again, it's yet another indication to me that I think broadly speaking, the markets are now starting to stabilize. All the irrational behavior is starting to exit the system. The party is in the last few hours. Volume's going down, the alcohol's being taken away, people are hanging around with a little bit, lights are coming on, they're like, oh, I've been here a little too long. And I think that that's a very healthy process for an economy. And I think that that's what's happening right now. So I'm constructive. I'm a little bullish. I'll go out on a limb. I think, we could be 3 to 5% from the lows, but we're more near the lows than the highs.
It certainly feels like the double bottoming out process was the bouncing along the bottom. And yeah, who knows how hard the landing is, but I think it's a great setup for startups and people who want to start companies. I don't know if you saw Gurley did a great interview that trended on the Twitter, and he was just saying this is the best time to start a company. And I have to agree with him. Like, you're going to have talent available. And like, who are you competing against for buying ads? Like, there's so many marketing opportunities available. The first thing to go in a down market like this is advertising and marketing. So,
and by the way, we will also relive what we have empirically known to be true, and it's been pretty well proven. The investments that one makes in this period will probably be the best for many, many years to come, because they'll have the most asymmetric upside. And that was true in 2008 and 9 and 10. It was true in 2002, 3, and 4. You're talking incredible companies just in those two periods. Think about this: Atlassian, Tesla,
Uber, Google,
Airbnb, Uber, Instagram, WhatsApp. Incredible businesses that have created tremendous value. And so there are businesses that have been invested in for the first time in 2022 and will be invested in for the first time in 2023 and 24, which will be the leading winners of this next phase and this next leg up. And so the real opportunity is to find out who those companies are and get behind them, I think.
100%. As I always tell people, fortunes are made in the down market. They're collected in the up market. Freeberg, what are your thoughts here in terms of the startup community or company builder and talent? Because that seems to be the piece that could be a silver lining on all of this maelstrom that we're going through.
I mean, technology always marches forward. So there's always progress to be had and to be made. That's one universal truth about, it's weird that we call it an industry because a lot of technology companies in Silicon Valley today don't sell technology to other companies, which is how Silicon Valley started. Nowadays, Silicon Valley is reinventing other industries by being technology led. And that is certainly still true because there are so many, I hate using the term, but undisrupted industries to pursue efficiency gains across, and technology built in Silicon Valley can drive that. Now, when I say Silicon Valley, I don't mean the physical location anymore, and that's the confounding factor here, which is that there does seem to be this distribution opportunity that's also emerged at the same time, where people are doing remote work and work from home and distributed workforce models that seem to be highly effective. You guys talked about it last year, and I don't think they ever had an office, right? I mean, don't most of the people work from home there? And I think that the success that's been seen in software companies that have operated that model also changes the calculus, because not only are wages lower, and therefore the cost of operating is lower, not needing a fancy, expensive office in San Francisco is needed, but you can also access far more talent than you ever could before. You don't just need people to live in the Bay Area or New York or LA or wherever you're operating from. So from a software perspective, this is an amazing time. I'll tell you, there's a flip side to this. Like in life sciences, real estate is more expensive than it's ever been right now in the Bay Area to get lab space. There's a total dearth of space. So there's certain segments that I think are physical in nature.
Is lab space like a specific designation?
Dude, I mean, there's a revolution in genomics that's totally transforming all of biology and human health and
what I'm saying is, like, do you need
a
a certain type of location that's sanctioned for that? Yeah.
Yeah, lab space is a certain kind of build out, and it's not, and so there's a certain amount of square footage, and it's being built out a lot around the Bay Area. But the thing about life sciences companies is you do have to operate physically because you're building something physical. And so that is an industry that continues to remain very well funded and very competitive. And I think, there's still tremendous value. And by the way, there's a lot of public companies to invest in, not on the primary basis, but that are tools companies that are benefiting greatly from the continued demand and growth in spending in that category.
Sax, let's talk about competition. A lot of talk, of these large companies pursuing many different verticals. We talked about anti-competitive stuff, Lina Khan, the bundling in the suite of products at Microsoft, other firms. Now you have all these being cut.
Death to the Roomba.
Death to the Roomba.
By the way, did you see that Elizabeth Warren, of all the things she could send a letter to the FTC about, I guess she sent a letter about the Roomba?
I mean, Senator Karen is just too much, man.
I mean,
there's a lot of other stuff going on, man. You can let the Roomba slide. Just
Roomba?
let it slide. That's not important.
Well, you know all the things that are going on right now in 2022, it's the Roomba that gets that's above the line.
At this point, though,
unbelievable.
My point, Sax, here is
we're just sleepwalking.
Oh my gosh!
Sleepwalking.
What is going on?
There's a famous history of World War I called the Sleepwalkers, because that's basically what it felt like. Is they just sleptwalked their way to World War I. Basically, what should have been a minor regional war, the Third Balkans War, that nobody should have cared about. Nobody should have cared about this Franz Ferdinand guy, except for the Austrians yeah, exactly. But the whole world basically got themselves invested in this thing, and and this is what we're worried about. We're worried about the Roomba when the administration is sleepwalking its way into the next World War.
Well, I do not want Amazon, to control my vacuum cleaner. I'm just going to put that on the record, okay? Because what happens if
they know where the dirt is? They know which rooms are dirty.
What happens if they get a hold of Roomba? I'll tell you what happens. The next thing is they're going to go after Dyson, okay? And then once they do that, they're going to put chips in these things, and all of a sudden they're going to know exactly what Jason said. What are you eating?
Where your dust bunnies are.
Yeah, all of this stuff. This must be stopped, Lina Khan.
No, but Sax, to the point of competition, you're seeing cuts to all the non-core projects at these big companies. This is going to be great for startups, right? Like the idea that Facebook could focus on a fourth, fifth, sixth thing is going to go away. Yeah.
Well, look, you're right that great companies are built during downturns. PayPal was built largely during the downturn. The startup I created, Yammer, was built largely during a downturn. So listen, there's going to be opportunities. Innovation doesn't stop just because we're in a recession or depression. But I got to tell you, unlike Chamath, I'm having a hard time finding a silver lining right now. Part of it is the comments that Druckenmiller just made, and he's been right about this stuff. We've been talking about his predictions for over a year on this podcast. And
he famously shorted the pound for George Soros.
That was when he was first getting started. But yeah, since then, he's one of the most successful macro traders in the world and universally respected, and I think deservedly so. Remember, he said that this was in mid-2021. He said that the Fed was engaged in a radical monetary policy because even though we were starting to get inflation, it was around 5% then, that they were still engaged in this bond buying program. They were still bought like 160 billion of bonds. And he is the first one waving the alarm bell saying, what are they doing? Now his predictions have come true. I mean, we're in an inflationary spiral. And his prediction now is, his central outlook is that the Dow Jones will be in the same place where it is today in 10 years. And he made the point that, yes, equity markets do go up in the long term, but how long term are you talking about? From roughly 1966 to 1982, the stock market was sideways.
Japan had a lost decade as well. Like, this is not unprecedented. Right. After an asset bubble.
Right. And then from the Great Depression, it took until 1955 for the stock market to recover. So in the long run, the stock market will go up, but it could be, we could have a flat decade. This is his prediction, right? But he's a very smart guy. And then on top of that, that's not to say that you can't be one of the ones who make money during that period, because lots of people do. But we're in for, I think, a very tough economic period because of just this radical expansionary fiscal and monetary policy we've had. Basically, the Fed and the administration printed, the last two administrations, but especially this one, printed $10 trillion over the last couple of years. And the hangover
just fact check on that, Sachs. Most of that was under Trump, but continue.
No, it was not.
100% was. I'll pull it up in a second. But anyway, keep going.
We had Biden basically kept digging this hole. We had the $2 trillion of American Rescue Plan, which we didn't need. We just had another $2 trillion of the infrastructure bill, the Inflation Reduction Act.
$500 billion for student debt.
Yeah, exactly. So, Jason, what are you talking about? And this was all after the emergency was over.
But I think that you guys are debating the wrong thing. I think that what Druckenmiller, by the way, just to be clear, both Druckenmiller and I can be right, which is he's commenting on the real world economy going into a recession. What I'm saying is that the stock market tends to be 9 to 12 months ahead of where we are. Nick, throw up that chart, please, that I asked you guys to share, just to give you guys a sense of what I mean by this.
By the way, while you're doing that, Chamath, Jason, look, I will agree with you that a lot of the stimulus...
I'm just pulling up. He did 7.8 trillion.
Listen,
so
he's
done more than Biden, but fine.
A lot of the stimulus happened under Trump, you're right, because that's when basically COVID happened. Yeah. Remember, in that Q2 of 2020 quarter, the economy shrank at a 30% annualized rate. Everyone thought we were going into a Great Depression. And that's why they passed all the stimulus by huge bipartisan margins.
Druckenmiller's best point is that this is all post-vaccine, right? Yeah.
Yeah. So look, and I think we can definitely go back and second guess what happened during the Trump administration. There's an old saying that many of the worst ideas are bipartisan. And so, the spending that happened in 2020 was clearly bipartisan, and maybe it went way too far. But in the last 2 years, like Druck said, it was post-vaccine, post-emergency. And they kept spending. And it's not just the administration, it was the bond buying program of the Fed, where the economy was already fully back and they bought another 160 billion of bonds.
Yeah, I think the thing is that, I think Stan is a proven Republican, so maybe he is speaking a little bit of his book as well. I think it's fair to say that both Trump and Biden did not help, but overwhelmingly, I think where the problem stands is a central bank that was the same through both of those administrations. And I think we should probably focus on them because you're right. What they did was excessive. And what they essentially said is that if there is volatility beyond a certain amount and people cry uncle, we will not allow the markets to sort themselves out in an orderly way. We will step in. And that's what, again, what we just talked about, the central bank put. In this case, the Fed
interventions,
put. And these interventions really pervert a market because you don't know what's going on, and that has huge ramifications in the real economy. So, Nick, if you just throw up this chart, the the thing that is really important here, and what this chart shows, is essentially all of the hiking cycles that we've gone through since 1983. So 83, 87, 80, 94, 99, 04, 15, and the current one. And here's what I just want to call out for you guys. What's incredible is that other than the one in 83, so this is sort of like, that last big one, what we've seen is that the stock market has a tendency to immediately go to the conclusion very early on in a rate hiking cycle. And now, why is that important for normal folks listening to this thing? Well, the reason why that's important is right now we're in month 7 of a cycle. We obviously don't know how long it's going to be, but the odds are improving every day that we're near the end versus the beginning. And why that's important is, again, if you're thinking about when to, buy equities, for example, this is a really instructive guide, because what it tells you is the closer we get to the end, or more importantly, the closer we psychologically know that the end is coming, we start buying. And that's just a broad-based statement that has been true. So, what you see right now, I think, is really interesting, which is that despite all the bad information, oh my gosh, the Nord Stream pipeline blew up. Could it have been sabotage? Was it the CIA? Was it the Russians? Oh my gosh, big tech is slowing spending and firing people.
China's in a coup. I don't know if you saw that rumor. Yeah.
Or how about something more benign? The US, US yuan is really trading in a crazy way. The US euro is trading in a crazy way. The US pound is going crazy. Yeah. Despite all of that, every time we trade down, the market consolidates very quickly. And we sort of so I think we're forming a bottom. I do think that Stan is right. We are going to see a hard landing recession. Something will break in 2023. I hope it doesn't. I hope it doesn't affect a lot of normal people, but it's likely. But at the same time,
what do we define hard landing as?
So I'll tell you in a second. But at the same time, I think what's happening is in the equity and financial markets, we are consolidating a bottom because we're seeing through to that end state. And this is where cheap equity gets bought. So why is there a reason to sell now? I think a lot of the people that are selling, the smart money sellers that I talk to, are essentially right now selling to book in capital losses to offset other capital gains from this year, a term that's called tax loss harvesting. And so if you have gains through this year, which some of us do, this is the great moment to just sell the losers, to book the loss, to net it out so that you can minimize your taxes for next year. That's probably, I think, where we are at. And I think that's why there's still consolidated buying. So what is the hard landing, Jason? If I had to predict, I think what David said is absolutely right. You're going to see unemployment get to an awkward and uncomfortable number. 5-6%, I think, could be something that we see. And I think you're going to see a lot more companies pull way back on their spend because demand is going to really modulate. I'll give you a crazy example. What happens to all the people in the United States that are on ARM mortgages, right? Adjustable rate mortgages. When those things reset, they're going to reset 200-300 basis points higher. Their monthly payments are going to go nuclear.
Oh, it's already happened, Chamath. I literally had a family member call me about this, and they were like, "What do I do?"
So in the UK, in the UK, 40% of all mortgage dollars are interest-only ARMs that will reset in January to around 4%. 40%. Can you imagine how upside down the UK economy is going to be when people have to spend 3 and 4 times more to keep their home?
And then people have to go to work. So people who have not been participating are going to have those bills come in and they're going to have to go to work.
They're going to have to go to work.